In a system that just ain't right, gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the chains, shatter the illusion.
And here we go. Welcome. I am Matt. This is the Anarchist Investor live, coming at you every Monday through Friday at 12 Eastern, talking about contrarian investment markets, the economy, how to protect and grow your money without getting it stolen by some dirty banksters. A reminder, help me with the algo. Give me a thumbs up, a subscribe, a follow, and share this content because it helps people. Hopefully it's helping you and it can help others as well. So help me out with that. What are we looking at today? We are looking at, and this is like a big deal. I think today could be, I'm not in the market for like prognosticating, right? Like when I put out price targets and stuff, it's just for fun. I usually disclaimer my face off and be like, look, this is not a channel for like trading and all this other stuff, right? Like I'm not trying to sell you on some course to buy, stock options to make 10x returns in 2 hours, right? Like that's not what we're talking about. This is slow and steady as it goes. It's as slow and steady as it goes. But from time to time, there's some stuff that happens where I feel like I need to call your attention to it because my attention is called to it because it does somewhat inform, choices moving forward, whether it be to ratchet certain investments up, certain investments down, et cetera, et cetera. I talk a lot about crypto. I talk a lot about gold and silver, commodities, actual hard assets, things you can actually hold in your hand that have value. Well, I also crap on the stock market quite often. And because I believe it's a casino, I think it's completely fraudulent and manipulated, and it is leveraged against people that are poor, middle class, and it benefits a small subset of people. Well, that diatribe leads into this fact that occasionally we do have to pay attention to the stock market, though, because the stock market is basically psychology. That's what runs the stock market. You could try and put as many numbers to it as you want, but really at the end of the day, there's, certain people that are rational about valuations, and there are certain people that are completely irrational about valuations. And that's what causes the ebbs and flows. It's why something isn't just like one price today and then the next day it's another price, and that price is just based off of some logic that everyone follows. Everyone has their own logic. They all have their own perspective. Full disclaimer, I'm not an investment advisor. Any investments that you make, that's on you. I'm just telling you my perspective. I'm a guy with an opinion. So what we're looking at is the S&P 500 right now. The S&P 500 put in a all-time high back here in the beginning of April. Okay, so roughly 2 months ago, we had a all-time high in the S&P 500. And I'm looking at the futures right now because for some reason, TradeView, the actual S&P index data is sluggish or slow. So I'm looking at the futures, but you'll see the path is basically the same. Okay, all-time high in the beginning of April. And now we hit another all-time high, and the newest all-time high was set basically the 23rd of May, so a week ago. All right. Since then, we've had weakness. We've had a sell-off. We've had an attempted rally back, and then some more weakness. So basically, 5 days of trading where net on net we're down. All right. This happens all the time, right? It's just like just could be a general pullback. Right? We hit an all-time high. People are taking profits and the stock market comes down a little bit. However, one thing I've noticed in a lot of the dynamics that are playing out here, and if I just kind of look at my like stock list that I look at, a lot of these stocks, I mean, we continue to see these instances where these big companies, like today, it's Salesforce. They're seeing, I don't know how anyone can say that the labor market is strong, because Salesforce today reported numbers that were essentially telling us that companies aren't just hiring less people, they're actually letting people go. And so Salesforce is down 20% in a single day. Okay. You see these outsized moves where something was obviously overly valued, dramatically overly valued, and these repricings that happen instantaneously. Okay. This isn't the hallmark of an efficient market, right? The pricing or the value of something should gravitate toward what the actual pricing is. If it overshoots, that's fine, but then it should gravitate back. There should be some rational thought involved. This is part of the reason why I think that the stock market is very overly manipulated, is because there are forces that attempt to like amplify, specifically to the upside, the irrational exuberance that's associated with investing in stocks. Well, Salesforce.com is down 20% in a single day. So investors who thought Salesforce a couple of days ago was worth, $300 a share, they were just immediately proven wrong. And now that $300 a share is only worth $217 a share. And if they were to try and get out from that position, they would take a big loss, right? They would eat a huge loss on it. And this is not the hallmark of an efficient market, okay? But this isn't uncommon right now. And that's what's also scary about this. There are so many instances where companies that should be, I'll call them like, secure, not necessarily completely immune to losses and things like that, but companies that should have a decent amount of book of business, a reputation, a track record, people that are actually good at the helm, that are, trying to skipper the ship, so to speak. These companies continue to see these like large outsized moves one way or the other. And it doesn't seem like this is a market that's functioning properly. Okay. And I say that to then point back to the stock market and where we're at right now. And we've gone through a period of just, if I zoom out here, like if I put the monthly chart on here, this is a very long-term kind of like look at the S&P 500. Okay. But back in 2000 and then 2007, there was like a double top that happened in the S&P 500, and that led up to the great financial crisis. And obviously you saw the huge drop off that happened in 2008, 2009 as a result of it. Well, now we've had just this astronomical rally in the stock market, starting from the lows in 2009 all the way to this new all-time high that's been set in the S&P 500. And the rate at which this thing has moved upward is it's unfathomable, because we haven't seen dramatically higher increases in productivity and GDP, right? Like the economy hasn't gotten, basically if we take the top here, the economy hasn't 4x'd since 2008. Okay. It just hasn't. But we're seeing an S&P 500 index that's 4x'd. Okay. Of note is that it's denominated in US dollars. So that when you inflate the currency, this is some of what you get. But we've seen this recent all-time high, okay? And in fact, you had an all-time high in 2022 that then we broke through earlier, let's see, in January, okay? And now we're putting in a new all-time high. And when you look at these charts, whether it be on the monthly chart, I showed you the daily chart before, if you notice, this new all-time high is coinciding with what looks like a lower relative strength. And that essentially means that the buying support, the enthusiasm behind the upward move that got us to this high in 2022, this all-time high, in late 21 and early 2022, the same amount of enthusiasm is not present. And by enthusiasm, I mean money, right? So that typically means that in an inefficient market where liquidity is less on either side of these trades, you can end up with these large kind of outsized moves up or down, which means that the irrational exuberance has outsized impact to the upside. Okay. And that also means that when push comes to shove and fear finally enters back into the marketplace, that will also cause exaggerated downside movement in these assets. Okay. So what I'm looking at here with the S&P 500 is a potential for this being the last high before we finally have to pay the piper for everything that we've done since 2008. All of the money printing, all of the stimulus, all of the QE1, QE2, QE3, QE infinity, right? Like all of that price has to be paid because all of that was borrowing demand and productivity that we didn't have yet. It was borrowing on a credit card, and the credit card was already almost maxed. Okay. Right now, we got GDP numbers today that shows that the first read is like 1.3% GDP growth. That is well below the 2.5 that everyone hopes for with the U.S. economy. And on top of that, I think those numbers will continue to be revised lower as well. I mean, it's very much like anemic growth. And if you notice, 1.3% is very close to zero or negative numbers. And so you could see these revised numbers head negative because that's exactly what happened in 2008. We had some small positive GDP numbers that then got revised. And then all of a sudden, 4 or 5 months into the recession, everyone was like, oh, I guess we've been in a recession this entire time. That's just the way these things happen. It's like the obsolescence of some of these measurements it's planned. Like they want this to happen because the fog of war, so to speak, when it comes to investment, the asymmetric distribution of data amongst the people that have lots of money and the people that don't have very much money, it's planned. That's not anything new, right? And it's there so that you could be taken advantage of if you're on that, lower end of the available data seesaw, so to speak. Okay. So it looks like the S&P's topping out. I mean, that's my initial assessment. Could it trade sideways and move higher again? Yeah, sure. But I mean, if this is a textbook case of a cyclical top in the stock market, and then a subsequent recession and revaluation to the downside of assets, you'll see this higher high on lower relative strength. Okay, otherwise known as this is being a divergence. Okay, typically you want to see higher highs on higher relative strength. You want more strength driving the thing higher. That divergence can then turn into a sell-off. The Federal Reserve cuts rates. You get a reactionary rise in the stock market, like a relief rally, what they would call a relief rally. But then that relief rally tops out, and then reality sets in, and then the rug gets pulled. Okay? So this is the beginning of what I think is the topping process for the S&P 500. I think this could be the all-time high, like 53.50. This could be the all-time high that we see for a significant period of time. I mean, we're talking, depending on how bad the downside gets, you could be talking 5 years, 10 years. I mean, in the case of the NASDAQ, it was like, what? We were talking at least 10, 15 years before the NASDAQ finally got back to where it was at. Hold on. Let me remember ancient history here. Yeah, 2000. Let's see. Wow, work with me here, chart. Okay, the year 2000. I'm just on the daily. That's what's screwing me over here. All right. In the year 2000, the NASDAQ tops out at, let's see, roughly like 5,100. Okay. And that happened in, let's see, the month was March of 2000. All right. And then to get back to that level, it took us pretty much 15 years. 15 years to get back to that high. We pulled back again, and then to break through the high, it technically took us 17 years. So this dramatic move higher in the NASDAQ is also analogous to what we've seen within the S&P and the broader stock index as well. I mean, look at this. This is just like a vertical chart. It's not, there's no rhyme or reason here. There's no pause. Like even the pauses are truncated. And you might say, oh, well, yeah, they're truncated, but they're 20% drawdowns or 15% drawdowns in the market. Yeah, but even still, in the grander scheme of things, when you're looking at a marketplace like this is absolute lunacy. I got to be honest with you. This looks like the stock market of a country that is like a emerging, powerhouse in some area, whether it be technology or retail or something, right? Um, uh, Minerals, right? Like natural resources. This looks like the stock market of like an emergent economy, one that is growing by leaps and bounds. This doesn't look like the stock market of a country that is essentially a mature economy, right? A mature mixed economy. This doesn't look like that. And it's been fueled by a lot of stuff that's completely unsustainable. And so that's why I'm saying these highs that we're seeing right now might be not revisited for 15 years. It could be even more than that. It could be 30 years. Who knows, depending on how bad this gets on the downside. But from my perspective, it's got to top out somewhere. Now, there are tons of people that have tried to make a career off of calling tops. And what I'm telling you right now is this is not like a certainty. I'm not saying like this is the top. Okay. What I'm telling you is we're currently in a period of time where this is a candidate for the top. And you don't know it's the top until you get some kind of other confirmation. The best confirmation would be if all of a sudden we start to fall through 5,000 in the S&P. So we're trading just above, like 52.65 in the futures, right? 52.50 in the index. Okay. 250-point move downward, all right, would be a retest of this most recent low. If we materially or definitively break through that 5,000 level, that's your confirmation that this is the high of the cycle. Okay. Now, why does that matter? Why it matters is a lot of people have a lot of their net worth wrapped up in the stock market. And typically, when you get a run like this, people are over indexed towards stocks. I think they're over indexed on an average day. But after the stock market runs this much, people's investment accounts are always over indexed. Okay. Even if they're kind of like rebalancing as they go, there's still an over indexing to the stock market because of what I said earlier at the top of the program. But that being said, I think once this fall off starts, people will really start to get scared because it will also coincide with the labor situation, the unemployment or the employment situation getting worse, much worse. Okay. And I've already talked in previous episodes about how the labor situation is overstated as far as the quote unquote strength of the labor market. Okay. There are literally millions of people that are essentially removed from the workforce. And so it makes the unemployment numbers look way better than they are. The unemployment numbers, we're still probably operating at plus 5% unemployment if you take into account all of the participation in the labor force that has since left and is now either living off of transfer payments from the federal government and their state governments, people that are just completely disaffected, right? Like that group of people is large and significant, and if you counted them, even though they're not actively looking for employment, you would see a much grimmer picture. But so the unemployment number will begin to get worse. I mean, like the evidence from Salesforce.com is telling. When you have a company like Salesforce that's down 20%, like this is a huge asymmetric data situation. And if you don't understand what I mean, it's like, some people knew all of the information and then most people didn't know all of the information. And part of this picture, because Salesforce.com sells software packages and their business model is predicated on selling more licenses, right? For each person sitting at a desk using the software, their business model is predicated on selling more of those licenses. And so they need more people working in, sales and marketing capacity. Well, how is it that someone missed, actually, not just someone, most people missed the fact that Salesforce probably wasn't a good investment? Well, it's because you have an unfair picture of what the employment situation looks like. Salesforce is giving you a signal here. And if it gets missed, then, I mean, that's on you. But Again, this is the asymmetric data I'm talking about within the marketplace. It's why there are these like just bang, instantaneous revaluations happen. All right, let's look through the rest of the market. Let's look at some actual, like hard assets and investments as opposed to funny money that is traded amongst Wall Street banksters. The dollar, actually, I lied. the the dollar's down today after being strong yesterday, but we still just kind of see this back and forth motion in the dollar. It's almost kind of waiting for something to happen. I don't know what that something is. Could be the PCE number coming up on Friday. We'll have to see how it reacts on Friday, tomorrow. But yeah, dollar's down today after a strong day yesterday. So it's just kind of like net on net a trade. We'll see whether or not that ends up, following through, or if we get some buying pressure on the dollar again tomorrow after the number. Oil's weak today. Came up to this. I'm telling you, man, like people poo-poo technical analysis and stuff all the time, but I mean, at the very least, it clues you in on some things. Like, look at this. It comes right up to the line and pulls back. Okay, I'm going to show you something with the gold silver ratio as well in 2 seconds here. But oil pulled up to this line, 2 days of selling pressure. Now it's down to $78.30 a barrel. Again, this isn't necessarily indicative one way or the other. In fact, this could end up being an inverted head and shoulders with oil headed higher, especially if the Federal Reserve cuts rates, or if OPEC decides to be more stringent in terms of production and the supply drops. That will cause the price to increase dramatically as well. What else we have? Gasoline is down in sympathy, so that's kind of common sense. Copper continues to sell off here. All right. So remember, before copper had been strong, and there's some industrial applications for copper that continue to give it some demand. It will continue to give it some demand into the future, the distant future as well. So, if you are someone who likes copper, I wouldn't necessarily say that this is reason to, abandon investing in copper or anything like that. But it has had some weakness here in the last couple of weeks. Part of that being it just had such a dramatic rise. And if you notice, one of these trend lines that I've drawn here, copper popped through it, pulled back, retested it, held, and then ripped higher. It's now coming back to that line. The line should be support with a big asterisk. If the economy falls apart tomorrow, or if we finally realize that the economy has fallen apart, then copper could fall through that line. However, a lot of traders will probably pick this line as a place of support in order to then try and move copper back higher again. We'll see whether or not that happens. All right. So I mentioned gold. Yesterday on this program, I was showing you the gold to silver ratio. All right. And before I even show you the gold price, here's the gold to silver ratio. All right. And I don't know exactly, like I can't quote myself, like I didn't go back and watch it, but I literally pointed to this yellow line. And I was like, this is a long-term line of support for the gold to silver ratio. Right. It goes back literally decades. Okay. And it was sitting at basically a ratio of 72.7 to 1, meaning $72.7 of gold versus $1 of silver. Okay. Or however you want to break that down, an ounce of gold being 73.7 times more expensive than an ounce of silver. Well, wouldn't you know, it comes right to the damn line. Okay. And now we've reversed. And I said yesterday, look, in the short term, look for gold to outperform silver, just simply based off of this, not based off of any other kind of news or anything like that. It's just the way algos work. It's just the way traders work. Gold has been underperforming silver significantly over the last few months. This is now an opportunity for gold to not necessarily make up the stagger, but if you notice today, gold is up while silver is selling off. So you have gold up, and it was actually up a little bit more, an hour or two ago. But gold's up about a percentage point today at about 23.63 an ounce. And silver is down significantly. Silver has seen some profit taking here. All right. It's down almost 3%, which is a significant move for silver. But again, so is this huge run up in silver to get us from, 26.50 all the way up to 37 or 32.50, excuse me, $37. It's like wishful thinking. But if you notice in silver, you see this kind of flag pattern forming, and there's a similar pattern forming in gold as well. but silver was at the top end of this range for this flag pattern, and so silver is selling off as a result of it. Gold, on the other hand, is at the bottom end of the flag pattern, and so gold's flag pattern basically was indicative of people will now probably shift over and start buying gold because they feel in the short term gold is undervalued compared to silver as well as some other investments that are out there. So you'll see probably some buying in gold happen here. And as a result of it, you're going to see the silver to gold ratio rise as gold outperforms silver for at least a few days. Okay. I fully expect silver to kind of like trail a little bit lower, move sideways before that next pop in silver. You're going to see gold outperform it for a few days. Do not think that the silver trade is over, that the silver squeeze is over. These things sometimes they take, a big move and then they have to take a breath for a while. It could take a month, could take a couple of months, could take a year. Who knows, right? From my perspective, I think by June, July, late June, early July, we'll have a resolution here as far as the next move for gold and silver. But, in the meantime, you're probably going to see gold outperform silver. So that's basically my 2 cents. And it's just completely ironic that yesterday I pinpointed that level and that's exactly where it bounced off of. So look, broken watch, I don't know, or broken clock. All right, so that's it really from the, like equities, indexes, commodities. Looking at fixed income, interestingly enough, high yield bonds are up today. So the casino is weak and yet high yield bonds are catching a bid. Part of this might be because there's buying in US Treasury land. And when there's buying in US Treasury land, it means yields go down, which means borrowing costs go down. So in high yield bond world, that means that the risky corporate debt gets a little less expensive. And so that's probably why you have some buying here. Again, it's not a tectonic shift as far as the direction. This, if I zone out here or zoom out, again, we're still battling with this, downward sloping line of resistance sitting over the top of high yield bonds. If I had to put money on it, my bet is that this is going to follow that line and eventually move lower and lower as these companies finally give up the ghost and go out of business, because they've essentially just been artificially propped up by artificially low interest rates for, literally almost 14, 15, 16 years since 2008. Right? Like a ton of these companies probably should have gone out of business in the aftermath of the great financial crisis. And they didn't. They were held afloat. And like I said, there's a price to be paid for that. So my estimation is we will probably see high yield bonds continue to trend lower and fall away from this resistance line, or at least follow it lower as we get further into the depths of this recession. All right, let's follow along to crypto and finish out our day with crypto. So overall, the crypto marketplace is only up a little bit, but Bitcoin is up a decent amount. So Bitcoin is outpacing the rest of the crypto market. It's up over a percentage point right here. Again, Bitcoin also has this kind of flag pattern working. Yesterday, I pinpointed how this looks like an inverted head and shoulders, and it's kind of like the new meta of crypto. It's like the inverted head and shoulders in the right shoulder of an even bigger inverted head and shoulders, if that makes sense. Which essentially means from a charting standpoint, it looks like the next move is higher for Bitcoin. So, this doesn't necessarily look like we have to look for an exit point here. What I would do is I would start looking at where you want to take profit. Okay. That's always a good place to start, especially when you have big moves that have already happened, as well as the anticipation that this thing will break higher again. So does it top out at 80K, or do we fully realize that longer term inverted head and shoulders and hit 110 or 115? Only time will tell, but really, I mean, my more conservative piece of me is looking to take profit somewhere around 85 or 90 in Bitcoin. So knock on wood. We should see that play out here probably within the next couple of months. I mean, this wedge pattern will probably play out by say the end of June, early July. So again, same deal as gold and silver. It's really funny how these things just line up, right? And people will say, "Oh, well, that's just because of the algos and that kind of thing. It doesn't necessarily mean things that are manipulated and stuff, which I guess you could take that standpoint. But at the same time, because of that, asymmetric information component to it, right? Very few people really understand or know enough to kind of look at these things and see what those similarities are. But what's crazy is the more you look, the more you spend time watching the charts and the price action and everything like that, the more you find that these things line up. Like it's like clandestine. A lot of them will have the same time frame over which you see that they have to resolve themselves, and something has to happen. And what's crazy is about the time frame where it needs to resolve itself, like literally something will happen. A bank will blow up, or the Fed will announce cutting rates, or some other country will go to war. Like these things are incredibly synchronous, and it's just really crazy how they work out. I mean, like it makes you think you're living in the Matrix, really, when how it boils down to it. But by basically the end of June, early July, I'm thinking we'll have some kind of idea of what the next move is for Bitcoin as well as for gold and silver. So continuing to watch that. Like I said, the rest of the crypto space is lagging Bitcoin. So it's not up as much. In fact, you have a number of, crypto that's down. Bitcoin Cash continues. It's up a little bit today, but it's pulled back and it's been a little bit weak recently. Again, I fully expect you're probably going to get a pop in Bitcoin. And then that pop in Bitcoin will be very quick. You'll see profit taking. You'll see people rotate into some of these other mid cap and small cap cryptos. And then that will be the end of this cycle. I fully expect that to be the case with a crypto down cycle, like a bear market that coincides with the recession that the stock market and the real economy will be going through. And you'll see a lot of these smaller cryptos go out of business, but that's just the nature of it. I mean, this is the Wild West. It's a new technology. It's a new advancement. You're going to see a lot of money pumped into projects that eventually will close up. Okay. So it's also why you kind of have to know what you're putting your money into, and you have to keep your head on a swivel when it comes to these things. All right. What else? Before I close out crypto talk, later today, 6 p.m., I have a interview that's dropping as a live premiere on all of the video platforms. It will be released like maybe an hour or two later on podcatcher platforms as well. It is with Vinny Barbosa, who's a writer for Finbold. We talk Nano, Hive, Bitcoin, the general, broader crypto market. He spends his entire day writing about crypto. So it's absolutely fantastic chat. If you are not subscribed to the YouTube or the Rumble channel, or if you're not following me on Twitter, aka X, do so now, because you'll want to be reminded when that interview goes live at 6 p.m. tonight. It's absolutely fantastic interview. So keep your eyes open for that one. Speak of the devil, Hive is down today along with the rest of the crypto space. Whenever I have, so like Hive is a weird ecosystem. Hive is a very much kind of self-contained layer one crypto, but it has a bunch of like tokens and coins that are built off the top of it. But in that primary layer is the Hive crypto, and then that Hive crypto you can stake, and then there's also a stable coin called the Hive back dollar, and you can move back and forth between those two. Okay, and the Hive back dollar is analogous to the developers over at Hive will tell you that it's not the same, but it's similar to US dollar coin and USDT and that kind of thing. When Hive goes below 30 cents is typically when I start moving my Hive back dollars back into Hive crypto. And then as it ramps, then I pull some of that out. Part of that is because the stable coin that is attached to Hive has a 20% APY. So it's literally an analogous is a dollar savings account, like a dollar-based savings account that gives you 20% interest. Absolutely insane. It's an incredible setup. But when the price gets below 30 cents for the actual base layer crypto, I start moving those Hive back dollars back into Hive, because I fully anticipate that there's going to be some strength moving forward with Hive, not just over the next, couple of months or years, like literally decades. This project, this base layer has staying power. And what's beautiful about it is it's internationally diversified. And so you're talking about nodes throughout the entire world. You're talking about a user base throughout the entire world. it's an incredible story. So I'll have to do some more kind of like deeper dives into Hive, both in terms of the newsletter as well as in terms of on this show. And I'm trying to get a couple of interviews set up with people from the Hive ecosystem that can clue you in more on why I'm such a big advocate for Hive. In fact, right now I'm live streaming on vim.tv, VIMM.tv, which is essentially like what's the like it's like a Twitch, right? It's like a Twitch streaming platform, but it's on Web 3.0 and you can earn crypto for it. But yeah, if Hive breaks below 30 cents, down to 25 cents wouldn't even worry me because again, there's this big consolidation range. If I kind of zoom out here a little bit, this consolidation range is at the lower end of the range of where Hive has been valued over the last couple of years. But that being said, I'm not too worried about the staying power of Hive. I think it's going to continue to be strong. Might take a little bit of a step back in terms of price, but anything below 30 cents, I'm a buyer. And so especially if we break below 25 cents, I'm moving some of those Hive back dollars into Hive. What else am I looking at? Privacy coins are actually having a pretty decent day. Monero's up 3.82%. I think that privacy coins are going to be more important moving forward, especially with the central bank digital currency atmosphere that we're moving into. Tomorrow afternoon, I have an interview that I'm going to be recording with Aaron Day, and we're going to be talking about that very topic. Privacy coins, the hijacking of Bitcoin, and the crypto system, and how that's going to work as far as transactional money into the future, as well as the technocratic dystopian future that awaits us attached to CBDC rollouts in many countries. So don't miss that as well. Another reason to be subscribed. All right, what else do I have? That's really it. I mean, the broader marketplace is down today. Crypto is up slightly because of Bitcoin, and really we're waiting to see numbers tomorrow morning, right? As we wait for those inflation numbers, I think a lot of people place bets based off of what's going to happen. Some of them will be right, and some of them will be woefully wrong. When the numbers come out tomorrow, I will probably write about it in the Substack, so make sure to be subscribed, anarchistinvestor.substack.com. And I'm also giving away 4 paid annual memberships to the Substack on Monday, the 3rd. So you have to be in it to win it. You got to be at least a free subscriber to be eligible for that giveaway on the program here on Monday at 12 Eastern. So, yeah, that's all I got. Check out the interview later today at 6 p.m. Eastern. It's a really good one with Vinny. He's a cool cat, lives in Brazil, new dad, and he's just living the life, getting paid in crypto full-time, writing about crypto. Absolutely awesome interview, so definitely check that out. So with that, everyone have an absolutely fantastic afternoon. I appreciate every single one of you for making it this far. And yeah, I'll see you tomorrow. Happy almost Friday. Peace.
Stuck in a system that just ain't right. Gonna tear it down, gonna start a fight.